Hello everyone, Dibyu here. Today I want to discuss about a topic that is there in your part 2 of your CMA exam section E, investment decisions, which we also commonly call as capital budgeting. Now this is of course going to be a very long discussion, cannot be covered in one lecture alone, but in a series of lectures I will try to take you through the three basic steps. First, you calculate the initial cash outflow. Second, you calculate the annual cash inflow or savings. And third, you calculate the terminal cash flow. That is the gist of the capital budgeting. Whether I teach it for CA intermediate or for you guys, it's same. So let's understand the first part today. That is the first gist. How to calculate initial investment. Initial investment essentially means the initial net cash that you are investing at the beginning of the project. So you can also call it similarly that it is your initial, and I'm again emphasizing on the word net cash outflow at the beginning of the project. Now, what are the components in it? As you can see in the table, of course, cost of new machine that you are buying. Of course, that will be there. But you also have to adjust for changes in working capital. If your working capital investment increases or decreases over the lifetime of the project, that is also taken into consideration. And third, and perhaps the most vital step where most of the students make silly mistakes in computation, after tax proceeds from sale of old machinery. So if you are buying a new equipment and you are selling the old one, then what should be the after tax proceeds that should be taken into account? Now let's look at it one by one. First is cost of new machine. Now what does cost of new machine actually includes? It includes amount paid for acquisition of the machine, that is purchase price. So when we are talking about cost of new machine, we include purchase price directly. And we also include any cost incurred towards installation of the new machine. Transportation, freight inwards, the amount spent on bringing the machine from the supplier's place to my factory, or testing of the machine. So essentially what I'm trying to say is when we talk about cost of the new machine, that is just a one line thing, but it includes four essential items. Cost of acquisition means purchase price that you have to pay to the supplier. Second, any freight inwards. If you are going to pay for your own transportation from supplier's place to your place, that should be included in cost of new machine only. Any cost paid to install this machinery so that it can be ready for production, that is to serve its purpose. So third cost is installation cost for the new machine is also part of cost of new machine only. And last, testing. So if you are having test runs, that will be also part of cost of new machine only. So essentially, if you understand, again, I am repeating because this topic is very important and lot of part 2 students mess this up. Even CA intermediate students mess this up. I've talked a lot, so I know that you have only four components under cost of machine that you need to take care of. If I want to briefly summarize it. First, you have purchase price. This you need to take care of. purchase price. You will add if there is any freight inwards. If you have paid any money for transportation of the machinery from supplier's place to your place, you have to add it up. You will also add installation cost. Of course, it's a machine. It might require certain installation costs so that it can be put into productive purposes. Any amount paid for that is also part of this only. And last, if you are testing, so you want to run some trial runs, you want to incur some testing costs so that to see whether machine is running perfectly or not. This is all part of cost of machine only. So if you see, the first one looks really simple, right? Cost of the new machine. Generally, people think purchase price, that's it. No, it includes four essential elements. One, purchase price. Of course, you all know this, but it also includes freight inwards. It also includes any installation cost and any testing cost. Now, second in this table is add or less changes in net working capital. Net, the word is very crucial. Means you can have some increase in current assets, current liabilities. You have to adjust for the net of it. Now, how do you do that? See, working capital, essentially the formula is current assets minus current liabilities. So essentially, if you understand that if you are increasing investment in current assets or you are decreasing investment in current liabilities, your working capital requirement will go up because the formula itself is current assets minus current liabilities. So if your current asset goes up, your working capital requirement goes up. But if your current liability comes down, then also your working capital requirement goes up. Or if your current assets goes down, your working capital will be reduced. If your current liability goes up, because of the formula current assets minus current liabilities, your working capital will be reduced. So when we are talking about step 2 for calculation for changes in working capital, I have this shortcut to remember. Add the following changes. Any increase in current assets, be it in receivables, inventory, any prepaid expense, anything you will add because of the project if you are incurring. If you have any decrease in current liabilities, be it accounts payable or any other current liabilities, you will add. What will you deduct from this? If there is any decrease in current assets. So if your investment in accounts receivable goes down, you should deduct. If your investment in inventory goes down, you should deduct, or any increase in current liabilities. If your investment in creditors goes up, deduct it because that money you are not going to pay right now. After this entire thing, when you add increase in current assets, decreasing current liabilities, of course, you will have a total. Generally, every question will not have everything. Maybe only one increasing current assets or decreasing current liabilities. That's it. Then you deduct the following changes, that is decrease in assets or increase in liabilities. So you deduct step 2 from step 1. If net is a positive figure, that means your investment in working capital has gone up. So it's a positive. It's part of initial investment only. And remember, working capital, when I will teach you terminal cash flow, I will remind you also. So working capital is an investment only for the tenure of the project. At the end of the project, you recover it in full. So if net is a positive figure, you will add it in the computation of your initial investment. And if net, that is step 2 minus step 1, is a negative figure, then it's not actually an outflow. You are saving some cash. So it should be deducted from the calculation of initial capital. So if you look at it, we have discussed just 2 steps out of this. First, and I have to keep on emphasizing. Once your concepts are clear, then nothing is there. Remember, CMA, as I keep on emphasizing, is not about where you can memorize the formula, solve 50 questions and go. No, you need to understand the concepts and then implement those concepts in the numericals and case studies. So cost of the new machine, four components: purchase price, yes; acquisition, sorry, installation cost, yes; freight and words, yes; any testing cost, yes. Changes in working capital, two components: if any increase in current assets, it's a plus; if any decrease in current liability, it's also a plus. Your investment in working capital is going up. On the other hand, if there is any increase in current liability, minus; if there is any decrease in current assets, minus. Then you should deduct step 2 from step 1 here. If net is a positive figure, your working capital investment has increased. You should treat it as an initial outflow at the beginning of the project in year 0. Remember, this investment will be recovered at the end of the life of the project in terminal cash flow. If it is a negative figure, which is rare case, I have not seen in generally in multiple choice questions or case studies. But if it is a negative figure, you will deduct it, because that means your working capital investment has come down. Step 3 or note 3, how to calculate after tax proceeds from the sale of old machinery. Remember, sale of old machinery, you will always compare two things: cash proceeds received. What is the cash inflow on account of selling these assets? You compare that to carrying value or book value. If cash proceeds is greater than carrying value, you will have a gain. If cash proceeds is less than carrying value, you will have a loss. So there is nothing. If you see, you will compare your cash proceeds with carrying value or book value. If your cash received is greater than the value of the machinery in the books, you will always have a gain in the books. If your cash proceeds is less, you will always have a loss. Now remember, if it is a gain, you have to pay some tax to the government, whatever is your tax rate. But if there is a loss, government will have to give you some share of cash. Of course, government will not give you cash. You will get a benefit of this in the future taxes payable. So you will get a tax shield on loss. Remember, tax on gain reduces the after tax proceeds, because some amount of cash will be taken by government, but tax shield on loss increases the after tax cash inflow, because some amount of money will be inflow from government as a form of tax rebates in the future year. This is how you calculate after tax proceeds from sale of old machinery. For calculating book value, as most of you are aware, we use carrying value, that is original cost, which includes everything: cost of purchase, including acquisition, installation, any transportation, less accumulated depreciation in the book. This is called book value, also often called as carrying value. This is the value at which machinery is carried in the books of accounts. Gain, again, when you have a net gain, you pay some tax. After tax proceeds will reduce. But if you have a loss, you will get a tax shield. Your after tax cash proceeds will go up. Now, of course, this was all theory till now, whatever I discussed. I was just explaining. If you guys basically understand, I was just explaining this first table only. This is the net or gist of the calculation of initial investment. You have cost of the new machine. You have any add or less changes in net working capital. And you have, from that, you deduct after tax proceeds from the sale of old machinery. This is your initial investment or initial outflow. Of course, if this is the first lecture, we will solve right now one MCQ. But in the next lecture, we will solve 4 or 5 MCQs. Some difficult, some easy to cement our understanding of the concept. So let's solve one MCQ today. ABC Limited is analyzing a capital investment project using discounted cash flow analysis. So there is an ABC Limited, and they are analyzing a capital investment project, capital budgeting investment decision using discounted cash flow analysis. The new equipment will cost $250,000. Installation and transportation will cost $25,000. So this is also part of cost of machine only. Now, existing equipment will be sold. It has a tax basis of $1 lakh and market value of 80. That means market value, of course, what will the buyer pay you? The market value. So market value is 80. Instead of book basis, they are telling you tax basis. Actually, that is what is relevant to me, because this entire gain or loss is for the purposes of computing tax from this tax payable or receivable from the government on sale of old machinery. If there is zero tax, this is not relevant. Whatever you receive, 80,000, that becomes a relevant thing. ABC Limited estimates that the new equipment capacity will generate additional receivables and inventory. So you have some investment in working capital also, 30. But payables will also increase by 15. Annual incremental pre-tax cash flows are estimated at 75. This is relevant for annual cash flow calculation, not here. The effective tax rate for ABC is 40%. What is the total after-tax cash outflow occurring in year zero? That means the initial cash outflow. Let's prepare the table and fill this up. I'm putting this to the next page. That will make my life easy when I'm solving the question. This all we will deal with it next. So let's prepare the table and fit it here. So if I see here that ABC Limited is analyzing a capital investment project using DCF analysis, the cost of the new equipment is $250,000. Installation and transportation will cost 25. So let's prepare the table first. This will be your particulars, and this is your amount in dollars. Now, first, as we said, in note 1, we have generally cost of machinery or new equipment. What did we discuss? It includes 4 costs. What are those costs? Purchase price, installation, any freight inwards, and any test cost. In this question, they have only 2 of this cost here. The new equipment will cost 250. This is the purchase price. And installation and transportation, they have all put it in one place, only 25. So we add these 2 figures, we get our cost of new machinery. So this is it, because there is no other cash to consider. Step 2 or note 2 here is add, or it can be less as well. If it is less, I'll just put it in bracket. Net investment in working capital. WC means working capital. Now, as I had told you, if there is any increase in current assets, we add. If there is any decrease in current liabilities, we add. If there is any increase in current liabilities, we subtract, and any decrease in current assets, we subtract. In this question, I see that the new equipment will generate additional receivables and inventory of 30,000. So I have an increase in current assets, 30. While payables will increase by 15. So I also have an increase in current liability. So I should deduct step 2 from step 1. This is in step 2. That is a positive figure. So my working capital investment has gone up. Step 3, where I have to calculate after tax proceeds from sale of old machinery. And students generally mess up here only. But if you understand, your life will be easy. So let's do it properly. Only for this, I'm preparing one more working note because this is the most dangerous area where generally mistakes are made. Now, they are telling you existing equipment will immediately be sold after installation of the old equipment or new equipment. Sorry. Existing equipment has a tax basis of 1 lakh and market value of 80. So of course they are not telling you cash inflow, but I will get what is market value only, right? Nobody is going to pay me more than the market value. So cash proceeds from sale, 80,000. Now they have not given me book value, but tax value basis is what I need, because whatever is the basis for tax, only that much deduction I can claim as part of loss. So my tax basis is, remember, if carrying value and tax basis, because you can have different methods of depreciation for books of accounts and for tax purposes. If both book value and tax value is given, always go for tax value, because the entire purpose of calculating depreciation tax shield or the tax payable is for tax basis only, because you pay taxes to the government or get rebates based on your income tax returns in India and IRS returns in US, not on the basis of your books. So tax basis is $100,000. So this is a loss. The value of the equipment in the your tax returns is $1 lakh or $100,000, and your cash proceeds from sale is only $80,000. So there is a loss of $20,000. Now, government has to bear a share of this loss as well. When they are partners in your business, when they are coming for the profits, they will also bear a share of their loss. So, what will be their share of loss? The tax rate. We call it tax shield, because they are not going to give you cash. They are simply going to tell you that when you have future taxable income, deduct. So on this $20,000 worth of loss, you will save $8,000 worth in future taxes. Understand this. On this $20,000 in loss that you have today, you will have $8,000, or you can save 8,000 worth of dollars taxes in the future. So what is your after tax proceeds? You have cash inflow from sale, that will be 80, and you will save 8,000 in future taxes. This is your after tax proceeds. If you had a gain, you would have to pay some taxes. So 80 plus 8, because saving in taxes is equals to cash inflow only. There was a very famous teacher, I don't know if you guys know or not, for past CA final, Sanjay Agarwal sir. He used to say a very famous line, पैसे का ना जाना भी पैसे का आना ही होता है. So because I will be saving taxes for this in the future, so I will pay less money. This is equivalent to cash inflow today. So cash inflow is 80. Tax shield on benefits, I will have 8. After tax proceeds, I will have 88. This should be deducted. Now I have my initial cash outflow or initial cash investment. that is 275000 plus 15000 minus 88000. 2,02,000 or $202,000. This is my answer. So this is, so understand, if you understand capital budgeting, it's not that hard. Break it into steps, like we will study step 1 first, step 2 first, step 3 later. And we'll solve a lot of numericals on it as well to make sure your understanding is very clear. And as I keep on repeating, remember in part 2, C and A will generally be your friends. They are easy concepts. But if you can make B and E your friend as well, you'll generally pass with flying marks. Focus on concepts. Do not try to memorize anything. It will not serve you much. So focus on concepts. Try to understand concepts and solve a lot of multiple choice questions, because that will make your understanding better. So that will be it, guys, from my side for this session. If you like the video, of course, like, comment, and subscribe to the channel. And if you have any other queries, you can always WhatsApp me on my phone number. Thank you, everyone. Have a good day.